Okay, good. So it's just coming on 10 o'clock. Just a quick reminder, it is a live webinar broadcast that can be quite heavy on your broadband internet resources. So if you are using other programs which require those resources, maybe Skype or TweetDeck or something like that, it is worth closing them down, and that way you'll get a pretty much, hopefully, uninterrupted broadcast. It is January the 6th, or Monday the 6th of January 2014, the first full trading week of the year. Welcome back, guys. I hope you've all had a fantastic end of year break. I'm sure some of you managed to get away to warmer climes, and if you already live in warmer climes, then maybe you got away to some colder places. If you stay at home, I'm sure you managed to catch up on all of those jobs and errands which had been left to the wayside while you spent 16 hours a day staring at a screen. Nevertheless, it is back to the grinding wheel now, and time to get back to work. On the calendar this week, reasonable number of events on there to cause some excitement, whether other market participants and whether the price ends up reflecting that this week still remains to be seen. Things kick off today with the release of PMI numbers out of the UK and the USA. Later on today, we do have 10:30 p.m. GMT. We have Fed Chair nomination vote in the Senate. Janet Yellen, widely expected by a margin of about 100% or something, to be voted in as the next Fed Chair. I think this is the final step before she takes that position. She's a dove, of course, and in all likelihood we're going to be carrying on with the Fed policy as already stated in their forward guidance. So we're not really expecting a lot of volatility around that particular event. On Tuesday, we've got US trade balance. Wednesday, we have the release of the FOMC minutes from the December meeting. Again, it's going to be worth maybe having a quick eye on those, although we already know what's been said. On Thursday, that's where it does really start getting exciting in the UK. We have the Bank of England with their latest interest rate decision and their rate statement with the asset purchase facility. And as well, we have the ECB with their minimum bid rate. And following the release of the minimum bid rate, there is usually a press conference that happens around about 1:30 GMT. And it tends to be a fairly volatile event, so always one which is worth monitoring. If all of that is not enough for you, then the week ends on a Friday with the release of non-farm payroll figures. There is a consensus number out there, about 195K, and I guess, if we start seeing consistent results above 190, above 200K, and that starts developing into a bit of a pattern this year, then we're already expecting tapering to begin this month, but it may well be that the market will develop an expectation that the bond buying program in the States may be finished by the end of 2014. So quite a lot going on there, quite a lot to be determined from the figures which will be released, from the numbers which will be released this week, so quite a lot to look forward to. As far as things stand technically, there are a number of charts that I want to look at this morning. I want to look at the pound dollar. I want to look at the pound Canadian and possibly the pound yen. Looking at all of the cable crosses this morning, we're going to look at the yen crosses generally, the euro Canadian, and as well I want to outline this morning a general strategy which I use at the beginning of every year, and how I tend to play January, and as well to develop a trading bias during January. I want to kind of elaborate a little bit about that this morning, and then after, if there's time, I'm more than happy to take requests if there are any particular charts that you guys would like me to look at and help break down for you. All right, let's get started. So I'm going to start with cable. We're looking here at GBP USD on a daily time frame. We're just looking at the daily time frame because the wall which I have marked here is built on that daily time frame. So we are looking at taking the highs which are extended all the way back to the early part of 2013. And what we're witnessing here is that the wall has been established using previously established resistances. And whenever the prices come and struck the underside of that wall, we're seeing quite decent reactions on the underside of that wall, either when she strikes the wall or when she gets close to the wall. The most recent one that we've seen is just from the beginning of this year. The price went and hit the underside around about the 66 price handle, and she reacted quite strongly from that level. Now, from a technical perspective, and maybe, you know what, we could probably end up in a fundamental discussion about the cable too, but from a technical perspective, I'm all in favor of selling the underside of this wall, right? So if you go on my website and you see the trade note that I issued on the 16th of December, we discussed this particular trade wall at that time, and our discussion at that time was that, you know what, just ignore the fundamentals for the time being. Okay, you know, there's been a lot of good data coming out of the UK, especially for services and manufacturing, but you know what if the market is forerunning the news? You know, and that sometimes does happen, and sometimes the market can get way ahead of itself, right? So, you know, all this talk about a big recovery in the UK, a lot of positive news, your expectations are that maybe the situation is a little bit damper than it has been made out to be over the course of the last few months. And we may well see George Osborne is giving a speech in Birmingham, in his hometown, in the UK a little bit later on today. They're going to try and put a little bit of a dampener on expectations. The Bank of England has been talking about this magical number, 7% unemployment rate, and they've said, you know what, if we're going to be raising interest rates, we'll start considering that once unemployment hits 7%. And again, the key word has been that we'll start considering it. This isn't a foregone conclusion that is going to happen at that point. And my own expectations are when we get the rate statement on Thursday, and if there's a press release which is following that, at some point the Bank of England is going to really start stressing that, saying, look, we've said 7%, but it's not your line in the sand, it's not a red line in the sand that happens at this point, but we'll start considering it, and maybe unemployment needs to be lower than that. Maybe it needs to be 6.4, 6.2 before we can really start raising interest rates. The way that things are looking in the gilt market and the bond market at the moment is that the market seems to have priced in 1% raise in interest rate before the end of this year. There's an election which is going to be taking place in the UK in 2015, and I don't think that having a raise in interest rates in the UK is really any kind of possibility before those elections. I think it will be political suicide for that to happen, and there'll be ample political pressure on the Bank of England not to be raising interest rates, certainly before the next general election here in the UK. Right? So fundamentally, I think although there has been strong growth in the UK, we're not anywhere near where we were. We're not back at those levels where we were in 2007, 2008. We're very, very far off those levels as far as GDP is concerned. concern. In fact, the market has been forerunning the news. That's a general kind of sensation that we have. Nevertheless, from a technical perspective, what is it all about? It's all about having a risk-defined entry. That is what it's about. And so when we're looking at cable, we're looking at price hitting the underside of that wall. Anytime it hits the underside of that wall, I think it's a short play. All right. And in the near term, what we're looking at really is let's just look at the near term. In the near term, what we're looking at is resistance, which has been established around about the 64.90 area, pushing up towards the 65 handle. So in the near term, we're looking at shorting the 65 handle. And if she is pushing past that 65 handle, then certainly we will be shorting the underside of this wall on GBP USD, looking for further weakness on this instrument. And as long as the wall is holding, as long as the price is on the underside, from a technical perspective, we're quite happy to do that, and we do believe that there is potentially a fundamental argument there as well, although we do give precedence to the technicals actually over the fundamentals. And later on, I'm going to start talking about January strategy, and when we look back at the cable chart, again, it will make a lot more sense when we're talking about it in the context of a January strategy as a whole. Okay, just getting some messages there about the sound not being any good. It is a live broadcast, so if you're having trouble with sound, it's just to do with your broadband resources. And if you're using any other programs that rely on those resources, like I mentioned earlier, it is worth shutting those down. And that's the best way to ensure that you do have good quality picture and good quality sound. All right, guys. So if you can just take care of that on your side, I don't think it's a transmission problem. Usually you find it's a reception issue, and you have other programs open which are using broadband, and that slows down your download effectively. Okay. All right. So that's the GBP USD. It's gone in here on the underside. Now, what's interesting with cable is that we've got a similar technical which appears to be developing on a number of cable crosses. So this is GBP USD. I did send out an email earlier on this week to everyone on the subscriber list about the price hitting the underside of this wall. And if we're looking at the pound Canadian, you know what? There's something very similar going on here, right? Now, one of the things which I've found over the course of the last, you know what? I mean, I've been trading now for almost 8 or 9 years. So we're going back to 2004, 2000. You know what? It's almost 10 years. It's almost been a decade. I was saying 8 or 9 years. It's actually 9 or 10 years, right? We're approaching 10 years now. One of the things which I've found over the course of these last 10 years is that when I'm looking for a significant reversal, when I'm looking for something which I would say, you know what, this is the end of the current wave, and it's by no means always the case, but certainly when there is the end of the wave, it's not unusual to find that there is a trend wall involved in that in one way or another, right? So here we are on the pound Canadian. We've taken our resistances dating all the way back to April and June of last year, and lo and behold, when you extend that trend wall, it really comes as no surprise to me, because I've seen this happen so often. We're finding resistance on the underside of that trend wall, and very tight as well. You know, if you're kind of looking there, very tight resistance on the underside of that trend wall. That's the kind of trade that you can take with a 35, 40 pip stop loss, and you can easily pull 2-on-1, 3-on-1 out of that. And we're actually short on pound Canadian already, so in the money on this instrument. But our expectation, in the same way that we're looking at cable and saying, you know what, she's hitting the underside of this wall, is it possible that we're going to get a significant reversal off of this? We're asking the same question about the Pan-Canadian, and if it's going to happen, you know what, I mean, you might be looking at 70 in the first instance, but if you really wanted to broaden your horizons, I have to put a little kind of warning ahead of this. I do have this trouble, I guess, like every trader has, where you become over-optimistic about every trade that you take. But if we're going to be over-ambitious, if we're going to be over-optimistic about the Pan-Canadian, then, why not work our way all the way to that lower wall of this broadening structure, right? So we have a broadening structure here. Would it really be unusual for the price to make the way from that upper wall to this lower wall, right? We might be talking 1,000 pips to the downside of this instrument, all right? Yeah, I know, fighting the flow, right? But who knows? And it really remains to be seen at this early stage of the year. But I guess as long as she remains below the 75.40 area, and I think we have a little resistance which has been established around 75.40, I'd be quite happy to be holding the short below that 75.40. In fact, in any kind of pullback 75.40, even that current market, you might think, you know what, sell a little bit. Let's see if she wants to carry on breaking down. But it's about 75.40, and as long as she remains below 75.40, I think that she's a good short. And if it happens that she breaks above 75.40, then the next time she goes to the underside of that wall, you'd want to be selling it again. Again, looking to see if you can get some kind of wave reversal at that wall, right? So, we have that upper wall there. She's reacting on the underside. In the first instance, the default play on the underside of that wall would be a short. If it happens that she ends up breaking through the wall, then on a pullback, you know what, it's been a pretty good resistance. You'd look for that same wall to turn support, right? So, there's a plan A here and a plan B. The plan A is to be shorting the underside, looking for a significant wave reversal. And if she really wants to go for it, we might be talking 1,000 pips to the downside. And if it happens that she breaks through that wall, then you might be talking about another 1,000 pips to the upside, with that wall having breached resistance, turning support. So certainly one that you want to have marked on your screens. And I really do like this, right? I like this Pan-Canadian chart. In fact, we talked Pan-Canadian and Euro-Canadian the last time I was here. In fact, it might be a good opportunity to turn towards the Euro-Canadian. There's our Euro-CAD, right? So if you remember the last time when I was here, we looked at this Euro-Canadian chart and we said there's a channel here and there's an upper lane and there's a lower lane. And our general price expectation from a technical perspective would be that whenever price is inside a channel, you expect, and I think the price was floating around here at that time, possibly, but you would expect for the price to move from the upper wall towards the lower wall and really remain inside of that channel, right? So Euro-CAD channeling right now, our expectation is that she would move from the upper wall to the lower wall. But one of the things that excites me actually about the Pan-Canadian is the possibility that the price may change lanes, right? So we've constructed a channel here, and then we've constructed a kind of equidistant channel above it and below it. And one of the exciting possibilities is that we may get a change of lane, right? So this is something which is worth watching out for over the coming weeks. If it happens that the price makes her way up to that upper channel wall and breaks through it, you will see a significant breach through it, right? We're talking a couple of hundred pips at least, like a very clear break through that channel wall. Then the expectation would be that any kind of pullback to that wall, you would find the price being supported there, and then a move to the upper end of the upper lane of that channel. And similarly, if it happens that she ends up breaking down any kind of significant breach, then on a pullback, you're going to get that support wall becoming a resistance wall. and then a breakdown to the lower end of that lane. All right, so she's channeling quite nicely to the upside right now. We would expect it to make a very clean technical play. Right, that's what we like the Euro Canadian. Just a very clean technical play. You're selling the upper wall of that channel. You can attempt to buy the lower wall, but if it ends up making a clean break through either of those walls, then on a pullback, it becomes a default buy, a default sell on a retest of the middle channel wall, right? So, very, very clean technically. This is one that I'm actually keen to get involved in trades on if she ends up playing according to the expectation that I've outlined here, right? So, EuroCAD, again, certainly worth monitoring. And again, if we're kind of looking at the euro and we're thinking about it from a fundamental perspective, we've seen quite healthy growth in the US, actually, not just over the course of the last year, but over the course of the last 5 years. Similarly, a lot of positive talk coming out of the UK, although it does only take one nasty piece of news to upset the cart here in the UK. But otherwise, all the kind of signs are there, and positive talk is there, and confidence is there that the UK economy has turned a corner, and you can expect more steady growth rather than this pattern of positive, negative, double dip, triple dip recession talk that we saw over the course of the previous 4 or 5 years, right? So a little bit more steady there. But if you're looking at Europe, Germany, well, she's always done all right. She's part of the core in Europe. We're starting to get good news out of the periphery. So we're getting good news coming out of Spain generally, Italy generally. If we're looking at the extreme ends, Ireland is no longer relying on a bailout. The Greece issue is still there, but I think one of the bigger issues that the market may start focusing on this year is trouble in the other end of core Europe, which is France. And the French economy is really struggling, and it continues to struggle. There's a huge problem there still with unemployment. There's this whole issue about the direction that the French economy is going to take, and really the slow pace in the French economy. There's a lot of positive news coming from there. Like I said, Germany really is the core, but the smaller part of that core, right, is France, and France really is not working. Maybe that turns into a story this year, right? So something to look out for, and what that might mean, right? What that might mean from a fundamental perspective is that there's this whole expectation that the Fed is tapering, and if the Fed starts tapering, it means that the bond buying program is going to come to an end at some point. It's a logical conclusion, and if the bond buying program comes to an end, it means that the economy is really outperforming, which means that the Fed funds rate is going to have to rise at some point. Look, this doesn't have to be 2014, 2015. This might not be 17 or 18 either, but that expectation will start growing, right? And we're already seeing that in dollar flows, particularly against the commodity currencies, particularly against the Aussie and the Kiwi. And we're going to take a look at a couple of those in a moment. If we're looking at the UK, again, it's the same kind of thing. That, all right, there's a recovery there. I think it's weak, in my opinion, but there is an expectation, and the market has been forerunning the real economy, but there's an expectation that at some point those rates have to rise. What about Europe, and the ECB? As long as there is trouble in the core, and as long as there is trouble in France and the French economy is not turning, is there ever going to be an expectation that European interest rates have to rise? And interest rates are a key driver for flows, right? So there is room there for euro weakness. There is room there for euro weakness, and we could well see each of these currencies the dollar, the pound, and the euro taking their own path in 2014, and you start seeing some real divergence. It's not going to be a risk-on, risk-off argument. It's not going to be a tapering-on, tapering-off argument. But what we might start seeing, and this is something that we haven't seen in many years, is the value of the euro starting to reflect European fundamentals, and the value of the dollar actually starting to reflect dollar economy, US economy fundamentals, and the pound starting to reflect UK fundamentals, right? We haven't seen that for a long time. We haven't seen that over the course of the previous 5 or 6 years, ever since the financial crisis kicked off. It was that whole kind of risk-on, risk-off argument. It had very little to do with the individual fundamentals of each zone, except for possibly the whole kind of Greek default issue, but that was resolutely dealt with, I guess. Maybe possibly not the best choice of words, right? Resolutely. Nevertheless, there's room there now for that to happen and for that divergence to take place in all of these currency instruments and currency blocks and pairs, right? So Euro Canadian, technical play, selling the upper wall of the channel, buying the lower wall of the channel. But if we get a break and the price is changing lanes, at that point, I think that would be the time to get really excited about what happens on the Euro Canadian. Okay, let's take a look at the yen crosses, right? So USD JPY, GBP JPY, Euro JPY. Let's use the USD JPY as our example, and I'm going to introduce at this point a general kind of strategy for January, a very general kind of strategy for January. And one of the most important things as a trader is just the ability to establish bias, right? So if I come to you and I say, all right, USD JPY, you're long or short, right? It doesn't actually mean are you in a position, but it's a question of saying, would you rather be a buyer right now? Would you rather be a seller right now, regardless of whether you've bought or sold or not? We're not talking about practically trading, the practicality of trading. We're talking about having a bias, right? So, your net short, net long right now, what would be the best direction to be looking in? And what I tend to do in January is that I look at the yearly open price, right? And this is something that you can do on every single instrument. And if you look at every single instrument on my chart, you'll see there's a blue line on every hourly chart. Where let's kind of get this coming up here, right? So for a USD, you've got the kind of blue line there with a Y on it, and it's just the yearly open price. So what I always want to know is how are we doing on the year, right? Are we net bullish on the year? Are we net bearish on the year? And my expectation is always for the price to break out in the direction of the year, right? So if we are below the yearly open price, by default, I'm looking to sell. And if we're above the yearly open price, by default, I'm looking to buy, right? Particularly in January, particularly when the price is close to that yearly level, right? Now, it may sound a little bit random, right? And if it sounds random, in all likelihood, it is a little bit random. But, when you're looking at a yearly range, and if you imagine what a yearly candle looks like, right? This is what your yearly candle looks like. You have an open price, and you have a body, okay, and you have a high and you have a low. If we're talking about an hourly, that range of that body, right? That might be 30 or 40 pips, okay, right? But if we're talking about a year, you can certainly add 1 or 2 zeros onto that, right? It might be 300 or it might be 3,000 pips. It really depends on the pair that you're looking at, right? So the best place to be taking a trade at the beginning of the year is near the yearly open price. And if the price is above that open, then you ought to be buying. And if the price is below that open, you ought to be selling. And if that direction holds and the price extends the yearly range, then you might be looking at capturing the entirety of that move. All right? So at the beginning of the year, the best place to be taking the trade, right, is at that yearly open price. If the price is below it, be selling. If the price is above it, be buying. Right? That's what I'm saying. Now, so there's a little bit of logic here. This is simple logic, right? The year is either going to be up or it's going to be down. If you're looking at a pair like GBP AED, right? She rallied nearly 3,000 pips last year. Okay? Same with the Euro AED. These tend to be fairly volatile pairs. We've had very good rallies on GBP NZD, GBP Euro NZD, Euro CAD, GBP CAD. They're all very, very good pairs to be looking at. They're the volatile pairs, right? Now, one of the things, though, which you're going to have to accept when you're using a simple price level, like the yearly open, is that, it might happen that the price breaks above it, and then comes back and breaks below it, and then goes back and breaks above it, and then comes back and breaks below it. You might be wrong 2 or 3 times, maybe 4 times, maybe 6 times, all right? It could happen with a strategy like this. But if you get it right, as the yearly range extends, it will allow you to build on that position as well and compound your earnings, right? So it is something which is worth seriously considering as a general strategy, as a general rule for establishing bias at the beginning of the year. Now, all right, so that's one. Second issue is that if you're using this strategy, marry it with the technicals, all right? So if your bias is short below the yearly open and the price is below the yearly open, it doesn't mean that you sell blindly at any price, all right? So you might wait for a pullback for resistance. You might wait for a trendline break to the downside. Any technical that you like to use it. If it's giving you a short trigger below the yearly open. And in a similar sense, if you are getting a bullish trigger above the yearly open, then you would use that as a cause in order to be entering into long positions, right? So it doesn't mean that you're going to get very, very poor risk definition using this strategy. You have to marry it with everything you know about support and resistance in order to get those tight entries so you can get really, really good R&R. And, if you imagine where you've taken an entry using maybe 40 pip risk and the price extends 400 pips, 450 pips over the course of the year, that's giving you your 10 on 1, right? It gives you a real R&R, not a lazy R&R like 2 on 1, which in the long run, even if you manage to get 2 on 1, it doesn't mean you're going to be profitable in the long run. But if you're pulling out 3 on 1, 4 on 1, 5 on 1, 10 on 1, you will be profitable in the long run with R&R like that, right? So it's a general strategy which I have at the beginning of the year. So the question with the yens is that, should you be buying the dips or should you be buying the rallies, right? And my answer to that is, if I'm buying the dollar yen, I would rather buy a rally above 105.20, which is where the yearly open price is. I would much rather do that than to be buying a dip below 105.20. And in fact, if I was doing anything, I would be selling the instrument. That's what I would be doing, right? If I was doing anything right now. And it doesn't matter if we find ourselves on the wrong side of a momentum break, even 2, 3, 4 times. It's not a big deal, right? You just position size accordingly knowing that that may well be a possibility, right? So if you take a smaller position size and you're wrong, it's no big deal, right? But if you're right, you can start building on that position size as, or start building your exposure as the price extends favorably in the direction that you expected it to, right? So I would rather be selling the dollar yen right now. You know, if you've been attending the whole of last year, you'll know I've been a huge dollar bull, right? It's very unusual for you to ever hear me say, sorry, not only dollar bull, but particularly on the yen crosses, I've always said bullish, buy the rally, keep buying the rally. Don't give up on this instrument, right? So you know how unusual it is for me to be advising to sell USD JPY, to sell Euro JPY, or to sell the pound yen, right? It's very unusual, right? But at this stage in the year, you just have to be prepared to flip your bias, to change your bias depending on the proximity of price to that yearly open price, okay? Dollar yen, I think it's a short right now. If we come back in a couple of weeks and the price is above 105.20, I'll be saying, look, I think it's a buy right now. And if we come back 2 weeks after that and we're below 520, I'll be saying, look, I think it's a sell right now, right? That yearly open is my bias level. That's what I'm using in order to determine my buy-sell bias. And then I will look for risk-defined entry levels where I can get in a little bit tighter than I would using a 70, 80 pip stop like what would be required right now at market, right? So I'm going to look for a condition, I'll look for a trigger that would allow me to short the instrument with a well-defined risk, and I'd look to hold those positions then as long as possible, right? And look for an extension in the body of the yearly candle. That's what I'd be doing, right? So GBP JPY, same story, right? So here we are just on the hourly time frame, and again you can see my blue line there. I've got the yearly level mark. That's coming in around the 74.30 area, and in fact on GBP JPY, right, there's this little block here, right? You can see that, you know, there's kind of support broke higher. That is coming in between 73.20 and 73.90, and my expectation would be that if the price pulls back into this block, it should get rejected from here, right? So I'll be looking for a rejection candle from somewhere between 73.20 and 73.90. If I get that rejection candle, I'll be looking to short this instrument. The yearly is 74.30, so any break above that in hourly or 4 hourly candle opening above that price, that would become cause to exit shorts on GBP JPY, right? But I do like this block, and I think that is worth marking on the charts. 73.20 to 73.90 area. Look for a rejection in price from that area, and that would become trigger for a short on GBP JPY. Looking for a move to the downside, possibly even extending down towards the 64 handle, right? So there may be 1,000 pips to play for here to the downside, all right? Worth keeping an eye on, certainly. Euro JPY, again, same story, right? So we have the yearly open that's coming in around that 45 handle. From a technical perspective, as long as the price remains below 45, I'd be certainly more interested in shorting the instrument than buying the dips, right? So I'm not a dip buyer, right? I'd rather wait for a pullback there and look to short on the underside of that yearly open level. If the price ends up on the other side of it, then at that point I would become a very, very eager buyer at that stage. All right. So again, you can see the kind of strategy in play here. You can see the kind of strategic thinking which is going on here, which is everything right now at the beginning of January. You know, I usually come here with a lot of trend lines marked on my screen, but I've come today with a lot of horizontal lines. And I'm saying, there's the yearly open price. Just trade the direction of the year, and you will come out a winner at the end of it. You'll come out a winner at the end of it, no doubt in my mind whatsoever. As long as the price moves away from that yearly open level, right? How could you lose? How could you lose? So, I've been doing this I've been applying this strategy for maybe 5 or 6 years on the trot, right? Just using that yearly open level in order to establish bias at this stage in the year, and it really does work. It really works. It never fails. You'd expect for the price to move away from that level, all right? You'd expect for the price to move away from that level. So that is one level that you definitely want to have marked on your charts, on your screens, right? So those are the yens covered. Okay, what else do we want to take a look at? We want to take a look at the AUD USD. So let's take a look at the Aussie. Let's take a look at the Kiwi too. Where are we? Aussie chart. Here we go. Okay. It's just interesting to note this morning and over the weekend. I follow social media, and I was looking at some guys posting on social media, and people have started talking about there being a double bottom here on the AUD USD. All right, I think that's quite interesting chatter, and I'm always a little bit careful. When people start talking about double bottoms, particularly on social media, because what you tend to find is that it isn't, and quite often a lot of if you just go against every call that you read on social media, you could probably make a lot of pips. You might have to use wide stops, but you'd make a heck of a lot of pips. But people started talking about double bottom on AUD USD, and I started looking at it for that reason. I thought, let me take a look at this. What's really kind of going on here? And I'm cautioning the double bottom call. And the reason that I'm cautioning it right now is that the last time the price was down here at this 88.50-ish kind of handle, we had quite a sharp reaction, right, to the tune of maybe 300 odd pips, okay? And then on the pullback, you had an even more sharper reaction to the tune of almost 1,000 odd pips, right? So she managed to push all the way back up to 97.98. Now, what I'm asking is, she's come back to this level. We had a very sharp reaction the first time. We had a pullback and a very sharp reaction to the tune of 1,000 pips. And here she is again, sub 90. All right, but we seem to be getting a shallow reaction, right? It's not a very sharp reaction this time. So if I see a significant stall here, and this stall extends for a long period of time, quite often people might be looking at that stall and saying, oh, she's stalling, and that means she's going to turn and she's going to end up breaking higher. I don't have a problem with that kind of thinking if that break higher happens now, or if that happens this week. I don't really have a problem with that thinking. But if she stalls for a significant period of time, the question that I'm going to be asking is, why isn't she breaking higher? All right, that's the question I'm going to be asking. Why isn't she breaking higher? Why not? We had a strong reaction here back in August, and here we are again at the same level and nothing. All right, so what that would say to me is that actually the bears are remaining very much in control, and what we should expect is for the price to break down further. All right, that is what it would say to me. So right now I don't have a problem, based on the level of consolidation that we've had right now. I don't have a problem with getting a break higher on AUD/USD. But if we see much more consolidation here, and we see that consolidation extend over the course of the whole of this week and possibly going into next week, then at that point I would use this consolidation to position myself short, because what it means is that the buyers are not strong enough to get that momentum breaking off. And maybe we should just look at the bearish momentum continuing at that stage. All right, so it's a little bit of thinking kind of required here, but I guess you can see the logic in the argument here, right? The logic is just saying that, we've had 300 pip reactions, we've had 1,000 pip reactions, and now we're getting nothing. We're not getting a bullish reaction. If we're not getting a bullish reaction, it means the bears are still in control. And if the bears are in control, then let us expect a further breakdown on this instrument. So we just want a confirmation of that. We want to see a much more sustained stall at this level in order to give us that confirmation. But I think it is a fair expectation as far as price is concerned. I think it's a fair expectation as far as price is concerned. We have similar issues with the Kiwi. Right? We have similar kind of issues with the Kiwi. In fact, I just want to mention just quickly, to turn back to the Aussie for one moment. It's going to drop down to an hourly. All right, and let this refresh. Here we go. All right, so there's our hourly, there's our yearly. All right, so well, that's coming in about 89.25. About 89.25. Michael, if you've got a different yearly level, don't worry about it too much. All right, it's not a big deal. The yearly level is just the price that the market closed at the end of last year. All right, so whatever price was recorded on the 31st of December, that's it. It doesn't matter who your broker is. It doesn't matter if it's 20 pips up, 20 pips down. Even if it's 40, 50 pips difference, it's not a big deal. All right, we just use it for general bias. It's just a line in the sand. That's all it is. And what it helps us do is to establish a bias. And if we're above it, we say we're long. If we're below it, we say we're short. You could take any price to do that from. It really doesn't matter. So it's like a little tool. It's a little trick that helps you establish a bias. But there's a logical reason for using that as a level to establish bias from. Right? That's the opening price of your yearly candle. All right? So don't worry if your price is a little bit in a rag from that. So on the Aussie, we've got it coming in at 89.25. And right now she's above that price. So I wouldn't be selling above that price. But like I said, if we see a sustained stall, if we get the price breaking down, why not? Why not? Right? There's no reason not to be selling at that time. So in the meantime, if you're bullish on this instrument, that stall is good. It's not a problem. But if you don't get her breaking out, if you don't get her breaking away from that level, then I think it would be cause for concern. I think it definitely would become cause for concern. And if you get a sustained stall here, sub 90, then at that point, start expecting for the price to break down further and start expecting a trend continuation. All right, that's the AUD/USD. Kiwi. All right, Kiwi. Same story. All right, so there's my hourly, and you can see I've got that yearly level, which is marked on there, 82.36, 82.40, thereabouts. What is interesting about the Kiwi chart, and I'm sure I've shown this before, here is that, not the lines on the chart for some reason, but there is a broadening structure here. It looks something like this. I'm just drawing it rather crudely here on my screen. There's a broadening structure here on the Kiwi. Ordinarily, when you have a broadening structure, it's not unusual for the price to move from the upper wall to the lower wall. We've seen that happening here. So here she is possibly making a new double top at the upper wall, and our expectation would be that she'd make her way to the lower wall. All right, now we have resistance which has been established at the 84 handle, and what I would be saying is that as long as the price remains below the 84 price handle, then my expectation would remain that she's going to make her way to the lower wall. Above 84, then you're looking at resistance being breached, a pullback, and you're looking for, if I'm drawing price going to the left for some reason, but you're looking at another move towards the upper end of that broadening structure, right? So 84 is the kind of deciding level. It's your kind of flip area on the Kiwi, all right? As long as she remains below that level, it's not unreasonable to be looking for further weakness on the instrument. But if she ends up above 84 and she's already above the yearly open price, then at that point we would look for another move towards the upper end of that broadening structure. At which point, and it doesn't matter what the price is when she reaches there, right? It could be 85, it could be 87, it could be 90. We're not really bothered about what the price is when she reaches there. But when she does, we would look to be shorting the instrument at that moment in time. So we have a long-term play here on Kiwi. We have a price expectation that we've developed. In the near term, we're looking at further downside, targeting the 77 handle. But if the price is breaking above 84, then we're looking at the price certainly reaching. And in fact, if I do something like this, and let's just kind of mark the level on crudely. So here we go. What are we looking at? If she was going there today, it would be 88. So if we allow her to take a little bit of time to reach there, we're talking about the 90 handle. All right? It's a possibility. It's a possibility, right, that she could do that. But we do want to see that 84 resistance being breached, and that 84 resistance being breached would be confirmation that she's set to make a move higher. Otherwise, I'm quite happy to be looking to the downside on this instrument and seeking 77 and maybe even lower than that. All right, so a general bias there for the Kiwi. As usual, though, you want to keep an eye on the hourly. All right, you want to keep an eye on the hourly and I'm saying hourly. I have the yearly level marked on the hourly chart. You want to keep an eye on that yearly, and I wouldn't necessarily want to be selling it above that yearly. But if I see her breaking down below that level, I would be quite happy to sell it at that point and then look to chase momentum to the downside on this particular instrument. Okay, guys, that's your lot from me. Let's have a look. What's everyone saying? Mr. C, do you have any charts before your tab? I missed the first 12 minutes. I think I covered everything in the first 12 minutes, actually, fella. Right, so you missed cable, you missed euro, you missed the yen crosses, probably, I don't know. You didn't miss much, yeah? Maybe just cable and GBP CAD and GBP USD, don't worry about it. Right, it's all, everything's short. GBP, JPY, alright, Michael, I've covered yours. Fellas, that's my lot. We have a short time left. If there's any questions, I'll be happy to take them. If there's any other chart you want me to take a look at, we've got 4 or 5 minutes. Otherwise, I think we're pretty much done here for now. And I'll be back here in 2 weeks' time. I'll be back here Monday the 20th. All right, so that's going to be my next webinar presentation. On the 21st, I'm heading over to the States. I'll be in St. Louis for a week. If you're anywhere near that area and you want to hook up for a coffee, just get in touch with me on Skype. My ID is WMD 4XX. So if you want to know about my training program, you can buzz me for the details of that. Otherwise, Mr. Pan on Fire wants to know about gold. You see, the gold chart is not even on my screen, fella. It's not even on my screen. Let's take a quick look. Is probably similar to what we presented for AUD USD, which is that the last time gold was here at this level, 1188, back in June, you saw quite a significant reaction. She rallied to the tune of about $250 odd from that level. Right? So if she's going to bottom here, then really what you want to see is actually quite a sharp break. Right? You want to see quite a sharp break to the upside. You want to get some trendline breaks going on. You want to start seeing a breach of resistance. You want to start seeing support being established above a resistance level and a break higher. And you can say, you know what? The bulls are back in play on this instrument. But, she's gone and hit this level and we've had a $30 reaction, a $40 reaction from that level. It hardly says that the bulls are really in control. Right? So I would look for the price to carry on breaking down unless there is reason to believe otherwise. And if I'm going to become bullish on gold, I really want to see some bull rallies. And I would rather buy a bullish rally than to be buying a dip on this instrument right now. So just applying a little bit of logic, just being a little bit sensible and thinking about it sensibly. I'm not a speculator. I don't like speculating at all. And I like having some confirmation, particularly if I'm going to be fighting momentum. All right. So if you're buying, I still think you're fighting momentum right now. It would be considered a speculative trade rather than something that has grounds or logical grounds for investment. Right. So look for further downside until you are given reason to believe otherwise. Right. We don't have support structure here right now. We don't have resistance being breached right now. So look for further extension to the downside. And if we're getting a trendline break, that is what might give you a risk-defined entry on this instrument. If she stalls here for a long period of time, then my argument is the same as what I have on the Aussie dollar. So if she's stalling here like this, my question is, why isn't she breaking higher? And if I'm saying, why isn't she breaking higher, then my expectation would be that she would actually end up breaking lower. Right? So I'm not going to jump on the double bottom bandwagon just yet. I'd rather let it play out, and once a bullish rally is developing, then start thinking long on the instrument, rather than start assuming that that is something which is going to happen. Okay? I've been a dollar bull, but I just find it really easy being a dollar bull. I don't know what it is. All right? But, it's been a long time coming. It's been a long time coming, and as I mentioned earlier in the presentation, I think that this is probably going to be the year. We're going to start seeing dollar valuations reflecting the US economy, which it hasn't done for a long time, right? So maybe there's a lot more dollar strength to come just yet. And the other question to ask, and it was the same kind of concerns I raised when gold was up at those dizzy heights of 1900, which is like, who's buying right now? who's buying at 1900. And I'm not talking about your speculative buyers. I'm not talking about, I'm talking about on the street level, where in the real economy, right? Who's buying gold, right? And who thinks that gold is cheap at 1900? And I guess the real question you're going to have to ask, and this is a little bit different to when you're trading currency, right? Because it's a commodity. And you have to ask, at what point would people consider gold to be cheap? I think based upon recent moves, on a street level, if she's going sub 1,000, people may become interested and they think, gold is cheap right now, right? We were going to buy last year, but it was too expensive. It was 1,900, 1,800, 1,700. It was 1,200. But you know what? It's 900 now. And maybe that's cheap, right? And it's not cheap, but the real word to use is affordable, right? That's affordable, right? Why not to buy a little bit of jewelry at this time? Because it has become affordable, right? So that's the kind of consideration you have to have when you're trading gold. When I first started trading, I was trading gold, and I had, it gave me a lot of joy, but it also gave me a lot of heartbreak, a lot of tears. I'll tell you one day, right? It's a very, very, let's just put it this way, it was a very humbling experience at the end of it, right? But you have to have a little bit of a different mindset, and you have to ask about affordability when you're trading this particular instrument, and you have to be more aware of that than you are of the technicals, right? One of the other things as well you have to do with the trading gold is to be aware of, you have to be aware of correlations, particularly with mining stock. And quite often, if you start seeing, the mining section has been suffering actually for quite a long time. But if you start seeing miners picking up, right, and the gold mining sector picking up, then you would expect for the gold price to follow through. And similarly, if you start seeing strong rallies on gold and sustained rallies, and you see miners lagging, then one will always end up following the other, right? So you can get a lot of clues by following the mining sector. If you're a keen trader on gold, right? Not mining generally, but gold miners. By looking at their stock valuation, it's always worth kind of keeping an eye on. So this is an instrument where the fundamentals tend to matter a little bit more than the technicals, whereas with the currencies, the technicals tend to, or certainly seem to matter a lot more than the fundamentals themselves quite often, right? So regardless of what the fundies are doing, you can get good technical plays off of the currencies, but with gold, that's not always the case. And quite often you can find technical levels being completely blown through, and when that happens, a lot of people end up getting hurt. So just a little bit of care required with the instrument as a whole. Okay, folks, I think we have gone past our time. So once again, thank you all for attending this presentation. I'll be back on here in 2 weeks' time. If you have time, do check out my website. It's www.wmdforex.com. Details on there about my live trading room, trade notes, and everything else. Otherwise, I'll see you in a couple of weeks' time. Thanks as well to FX Street for providing the platform. Cheers, fellas. Bye.